Hello, welcome back to this week's market update. Today is Monday, October 27th, 2025, and we'll jump right in. It was another week of limited economic data due to the shutdown, as well as some new equity market highs, as many government-produced reports remained on hold. The delayed CPI was released despite the shutdown, given its importance for this week's Federal Reserve meeting, as well as the 2026 Social Security cost of living adjustment. As of Friday, October 24th, the Nasdaq Composite led with a 2.3% gain, followed by the Dow up 2.2%, and the S&P 500 up 1.9% last week. Moving into last week's economic data, after being delayed due to the government shutdown, September CPI was released, coming in at slightly better than expected. Annual inflation picked up slightly on a headline basis to 3% here. Core inflation actually declined slightly to 3%. So both metrics coming in at just about an even 3% for September. On a monthly basis, headline prices were up 0.3% and core prices were up a pretty tame 0.2% in the month. By category, grocery prices were up 2.7% from a year ago in September. Energy prices were up 2.8%, and this was largely led by fuel oil prices going up, as well as electricity and gas service. Shelter costs increased a pretty moderate 3.6%. This was stickier, closer to that 4% level, so definitely been improving on that front. And kind of an interesting dynamic on the new and used vehicles. New vehicles up 0.8% from a year ago, so less than 1%, while used vehicles are up more than 5% from a year ago. So very interesting trend in that market, kind of seeing weaker pricing power in the new vehicles, while used vehicles have seen some higher inflation there. Overall, with the recent inflation data coming in slightly below consensus, though, it was a positive development for markets last week, as the Fed should have greater leeway to cut rates in the months ahead. With last week's release of the CPI, officials were able to finalize the cost of living adjustment for Social Security payments in 2026. And just looking at how that calculation is made, it's based on the year-over-year price increase in the third quarter, based on an adjusted version of the CPI here called the CPIW. They take the ending value minus the starting value divided by the starting value times 100, and that's where you get that 2.8%, which is the COLA for the upcoming year. So you can see that directly translates to that 2.8% rate there, a bit higher than last year's 2.5% pace. But as you can see, over the last 5 years, it's been pretty elevated, all of the years being above 2%. With prior years, 2020, we had 1.3% inflation, 1.6% in 2019. Definitely trending higher for those costs of living adjustments, which is good news for retirees hoping to maintain their purchasing power with their Social Security payments. We also got existing home sales data for the month of September last week. It showed that existing home sales sold at an annualized pace of 4.06 million, which was up 1.5% from last month, up 4.1% from a year ago. So seeing a small boost from falling mortgage rates there. Inventory, though, has been stacking up quite a bit, with 1.55 million homes for sale, up 14% from a year ago. This also made about a 5-year high. So you can see we haven't seen these levels since 2020. 5-year high in inventory is very interesting as the market starts to normalize and become more of a mixed market for buyers and sellers. You can see that we have also seen the months of supply tick up to 4.6%. We've also seen the months of supply tick up to 4.6 months worth, up from 4.2% in September of last year. And then lastly, the median sales price rose a pretty modest 2.1%. We've seen housing inflation really slow to a more manageable level, and that amounted to $415,200 for the median sales price. After trailing many of its mega-cap tech peers for much of the year, Apple reached new all-time highs last week following reports of strong iPhone 17 sales. Now, this was a positive indicator for the company, but also for the broader economy, reassuring investors that consumer spending remains resilient. You can see the stock has still lagged other tech peers year to date, up 5.3%, also lagging the broader market. A lot of that came from the delay in recovery from March and April sell-off here. It just took a longer time for Apple to build back up. But in the last month or two, we've been seeing a lot of strong momentum in the stock, supported by these fundamentals in, strong iPhone sales in recent quarters. We'll get their earnings soon. But definitely a good indicator for the company and a good indicator for the overall economy. Last but not least, looking ahead to this week, we will have a Federal Reserve meeting. The current market probabilities are pricing in nearly a 97% chance of a 25 basis point rate cut this week, with just shy of a 94% chance of another 25 basis point rate cut in December. The odds for no further rate cuts by year-end sit at just 0.01%, which is 1 in 1,000. Now, this is just futures markets pricing. It's not a definite by any means, but it does show you that the market is heavily expecting rate cuts by year-end. So that concludes this week's market update. We really appreciate you tuning in. We look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.